After studying this module, we shall be able to number 1. Learn the concept of overall or combined cost of capital. Number 2. Calculate the combined cost of capital or weighted average cost of capital. Number 3. Know alternative weighing schemes for calculation of WACC. Number 3. Learn the concept of weighted marginal cost of capital. And lastly, learn to solve practical illustrations.
Before going through this module, we should be thorough with the concept of calculation of specific cost of each source of finance. Company calculates the specific cost of capital for individual sources of finance in the firm's capital structure, like the cost of debt, cost of preference share capital, cost of equity share capital, and cost of retained earnings. The next step is to calculate the company's overall cost of capital by combining all these individual costs together depending upon the weightage the each source of finance has in the firm's overall capital structure. That is the reason that the terms weighted average cost of capital and overall or combined cost of capital is used interchangeably. Weighted average cost of capital, WACC, simply refers to how much, on average, it costs the firm to raise money. Determining an accurate cost of capital is very important as it is used to analyze the capital budgeting decisions of a firm to see whether a future project will be profitable or not. WACC can also be used as a hurdle rate to assess return on invested capital ROIC performance. The return on invested capital measure gives a sense of how well a company is using its money to generate returns. Comparing a company's return on capital ROIC with its cost of capital WACC reveals whether invested capital was used effectively. WACC plays a key role in economic value added calculations as well. There are four steps involved in the calculation of WACC. These are: calculate the specific cost of each source of fund, find out the weight or proportion of each source of fund in the total capital structure of the firm, multiply the specific cost of each source of funds with their respective proportion, add the weighted component costs calculated in step 3 above to get WACC. Calculation of combined cost of capital. Let E be the value of all of the common stock of the firm and D be the value of all of the debt of the firm. Thus, E plus D must be the total value of the firm. Let KD be the after-tax cost of debt financing and let KE be the costs for equity financing. The WACC for this firm will be given by the formula as shown here. Thus, it can be said that WACC is equal to percent of the firm that is equity times cost of equity plus percent of the firm that is debt times cost of debt. There are basically three bases for assigning weight. These are historical weights. These are based upon existing capital structure. It assumes that additional finance will be raised in the same proportion as the proportion of funds in the existing capital structure. It is based upon the assumption that the existing capital structure is optimum. Marginal weights. These are based upon the proportion of funds in which the new capital will be raised. It is quite logical because it is very unlikely that a company is able to raise additional funds in the same proportion as they are in the existing capital structure. Target weights. Target weights are either book or market value weights based on desired capital structure proportions. The concept of historical weights and marginal weights can be made clearer with the help of the following example. Suppose there is a company with its present capital structure comprised of equity and debt. Out of total capital of rupees 50,000, debt component is 20,000 and equity component is 30,000. Now, if the company wants to raise additional finance of rupees 20,000, it has two options. First, it can raise the additional rupees 20,000 in the same proportion of its existing capital structure, that is, rupees 8,000 or 40% through debt and rupees 12,000 or 60% through equity. Second, it can raise additional rupees 20,000 in any proportion without referring to the existing capital structure. If the company goes for the first option, it would have been set to use historical weights, and if the company goes for the second option, it would have been set to use marginal weight. The historical weights can further be divided into two types: book value weights, market value weights. Book value weights are weights that use accounting values to measure the proportion of each type of capital in the firm's financial structure. Market value weights are weights that use market values to measure the proportion of each type of capital in the firm's financial structure. WACC, calculated using the book value weights, is generally lower than the WACC calculated on the basis of market value because the market value of the capital components is usually higher than the book value. Under market value weights, there is no separate cost of retained earnings. It is the same as cost of equity because retained earnings belong to equity shareholders only and therefore included in the market value of equity. However, if retained earnings would not be enough to cover the required equity financing, then the WACC will increase because a new stock issue will be needed, and this involves flotation costs, which are now included in the cost of equity. Both book value weights and market value weights have some advantages over each other, but they are also not free from flaws. There are some drawbacks as well for both of them. Let us first discuss the merits and limitations of book value weights. The book value weights are generally preferred by managers for calculating WACC because of the following advantages associated with book value weights. The book value information is easily available from the company's annual report. It is simple to use. The capital structure targets are usually fixed in terms of book value. It is easier to evaluate the performance of a management in procuring funds by comparing on the basis of book values. However, there are some limitations of book value weights as well, which can be seen as book values are based on arbitrary accounting policies and thus do not reflect the true economic value. They cannot be justified on theoretical grounds. On the other hand, market value weights are preferred and considered to be theoretically superior to book value weights because they reflect true economic values and are also not affected by accounting policies. The other points favoring market value weights are the sale price of securities is more close to the market value. The costs of specific sources of finance, which constitute the capital structure of the firm, are also calculated using prevalent market prices. But market value weights are also not free from limitations. There are some difficulties in using them because market value is subject to frequent and wide fluctuations, so they need to be normalized first to calculate the weights. Sometimes current market value is not easily available. Marginal weights refer to the proportions in which the firm wants or intends to raise additional funds from different sources without any reference to the proportion of funds in the existing capital structure of the company. The basis of assigning weights is new and hence called marginal weights. The features justifying marginal weights system are: the firm may be using some source of finance in its existing capital structure which may not be available currently. So there is no use of including its weight for calculating the WACC. It is practically very difficult for the firm to raise the additional funds in the same proportion as employed in the existing capital structure. This will give more freedom to the finance manager to raise funds after analyzing the costs and benefits associated with different sources of finance. However, the marginal weights system also suffers from the following limitation. The main problem is that if we go by marginal weights, we may resort to too much borrowing and accept many projects because of lower cost at the moment. But at a later date, the company may have the problem of raising more finance. Marginal weights ignore the long term view. Thus, the fact that today's financing affects tomorrow's costs is not considered in using marginal weights. Weighted marginal cost of capital refers to the incremental cost of raising additional amount of capital by the firm. So, While calculating the combined cost of capital, we should take the new cost of different sources of finance instead of taking their existing cost. It is the sum of weighted marginal cost of each source of capital.
Now, we shall recapitulate what we have learned so far. WACC simply refers to the cost that would be undertaken by the firm on an average to raise money. Determining an accurate cost of capital is very important as it is used to analyze the capital budgeting decisions of a firm to see whether a future project will yield profit or not. The basis of determining WACC is to determine the specific costs of each of the individual sources of long-term financing for the firm, assign weights to these individual sources of finance depending upon the degree to which the firm uses these different sources, and then simply add up weighted costs, that is the product of individual costs with their respective weights. The assignment of weights can be done on historical cost basis, marginal cost basis, or on the basis of target capital. These different sources and then simply add up the weighted costs, that is the product of individual cost with their respective weights. The assignment of weights can be done on historical cost basis, marginal cost basis, or on the basis of target capital structure. The historical weights can further be divided into book value weights and market value weights. WACC is the weighted average marginal cost of each source of capital.